Okay, so gold and silver have the potential to massively outpace inflation and potentially make you rich. Now, this is a theory, I'm going to call it the Overshoot Mechanism. And this is based on panic, okay? There has to be a very unique set of circumstances to set this trade up. But I believe those circumstances are playing out right now, the beginning phase, the very infancy of this play. So for this to work, I don't think it'll work with any paper contracts. It could, but you'd have to time it perfectly. You're still going to have to get the timing pretty right with physical gold and silver, but I think having it in your hands would be beneficial in this scenario. Okay, so I'm going to get back to gold and silver in a second here, but first let me talk about the situation that I envision. Now, in any inflationary scenario, when inflation starts to get out of control and it hits double digits, you tend to get a huge rise in commodity prices. And you get a peak, okay? And where to the point where it overshoots its real nominal value in terms of the money that was printed. Okay, we saw this in palladium and rhodium back in the early 2000s. We got a taste of this last year in gold and silver, to where they overshot. You know, they went higher than oil and everything else in terms of nominal value in dollars. Okay, there's also a problem with this trade, and I'll get to that in a second. But now, as far as the circumstances leading up to this, we're seeing the precedent for it right now. And at first I thought, you know, gold and silver would just keep up with inflation for the most part. But based on what I'm seeing in the markets, and especially the Eurozone right now, they are not going to let banks fail, period. They're just not going to let it happen. They will not tolerate any deflation. And I'm talking about the ECB and the Federal Reserve, and, you know, many other nations. You know, China is doing cash injections right now as well. So based on this, the fact that they're not going to allow any deflation and they're going to continue to put money into the system is what sets this trade up. Okay, because what happens is the money goes in, you get a little bit of deflation, money goes back in, and this loop continues. Now this money that's just sitting out there in accounts, in people's you know, retirements, IRAs, whatever, this money eventually will hit the market. Okay, so prior to this money hitting the market, technically the dollar, the euro, whatever, it's all incredibly overvalued at the current point, and will continue to do so in the future. Now, when this money comes to market, and this is where the panic phase sets in, okay, you have to have the panic for this trade to work, but again, I believe that's setting up right now. And the panic is when this money starts to approach zero at an exponential rate. Now, during this phase, commodities in general, but especially gold and silver, are going to spike over their nominal value in terms of other commodities. Meaning that oil's going to go up, food's going to go up, but gold and silver will skyrocket in this scenario. And there's a lot of precedents backing this up. Okay, the problem with this, well, I'll get to that in a second. So as the money comes flooding out of the market, they're going to look for any physical gold and silver possible. Okay, this is where a lot of people say, you know, the GLD, SLV will really have a hard time, and they're going to go up as well. But the problem with those is you have to trade back into dollars. Okay, so if you own this stock, the GLD, the SLV, whatever, you sell it back into dollars, and then you can convert those dollars into whatever else. But during a panic mode, when there's lots of chaos, that's not going to be a very easy thing to do. You know, there's going to be a lot of scrambling going on. But the physical metal is really going to spike big time. And again, you see this quite a bit with you know, any inflationary event, that you get that spike where it just goes way up, and all the money gets in at the top, and then it's going to pull back and then find a nominal level somewhere lower. And that spike where it goes above, okay, that's where you want to get out. We saw this with the housing bubble. Okay, you could have made a fortune in the housing bubble if you timed it right. Okay, plus or minus, I don't know, say 4 months to really get out at the peak. And I'm talking, I don't know, gains of, in the physical metal, if you get the panic that I'm envisioning with this scenario, I'm talking like 400 or 500% over its monetary value. So that's in terms of real purchasing power as far as, I don't know, say food or oil or cars or whatever, anything else. So this gold and silver spike, I think, is probably 1 year out, maybe a little bit more, 2-3 years. I mean, it's hard to say because it's all based on sentiment and when the money really decides to flood the market for the physical metal. Now, here's the problem with this scenario, is that you're not going to want to change back into dollars, okay? Because they will continue to approach their zero value. But I'm talking like, let's say, a silver to food ratio, okay? So that's what I'm talking about. That's where these gains are going to be realized, because you're going to have food's going to go up, but the big money, okay, the billionaires, the big banks, these hedge fund type people, they're going to get into that gold and silver and push it way higher. So you got the gold and silver curve going up like this. Food, oil, energy, commodities are going to be going up at a lower curve. And that separation, that deviation, is where you can realize these huge gains. So again, if you go back last year and you sold at the peak in terms of silver, you know, you would have made a huge gain versus, say, holding oil or holding food commodity in the same time frame. Again, because the big money is going to go there. Now, in terms of gold and silver, as far as money goes, I mean, it's almost limitless as far as how high it could go, because you have the derivatives bubble, which is, I've heard all over the place, but let's just say for argument's sake, $1 quadrillion, okay? So that's money that has to be printed at some point when these derivatives get called in. Again, based on the precedent that they are not going to let the banks fail, okay? They're not going to not make good on a treasury contract. All these things will get paid for. So $1 quadrillion. Now, if you divide that into the gold and silver, okay, and forget other commodities, because, again, panic, gold and silver, right? It's a very dense form of wealth storage, you know, in terms of, like, you know, you can buy a warehouse full of corn, or you could have a suitcase full of gold. What are you going to have if you're a banker or you're someone that's very wealthy, right? No-brainer. You're going to have the gold. So based on this, the timing is the hard part, though, guys. The timing, as well as what do you put it into. Okay, so the timing on this event, I think, again, 2 to 3, maybe 4, 5, 6 months where you get that overshoot. The quandary, how do you realize these gains? What do you put that into? And I'm thinking, and this is assuming, of course, we don't have a complete meltdown of the system and it goes Mad Max, because in that scenario, your gold and silver are not going to do too much for you. It's beans and bullets at that point. But I'm thinking that property is going to be the vector that you need to go into. So let's say you get this panic, silver goes to, and this is all hypothetical, but let's say silver goes to $1,000 an ounce and gold goes to $16,000 an ounce, okay, for argument's sake. It's not going to stay up there. It will in terms of dollars, and it will continue to go up. Now, see, this is the hard part, and this is where I think you might get into trouble if you don't time it right, because you'll see these prices up here, you know, 1,000 and 16,000, and then they'll go to 17,000 and 1,500, and they'll keep going and going and going. But that's when these two lines, these slopes I was talking about, so you get the gold and silver slope, and then you get the land, commodities, energy. Eventually, they're going to come back to a nominal value and meet at the top somewhere, but that gap is where you're going to make all your big profits. Again, I think it has the potential to make you rich if you time it right. So what you'd have to do is you'd have to look at property. Okay, let's say you see a huge spike in gold and silver, and property, real estate is going to lag. So you see, let's say a factor of 10, gold and silver. Factor of 10, gold and silver go way up. They spike, and property has gone up by a factor of 3. That's probably a good indicator right there, okay? Because eventually that property is going to catch up. And in the long term, property, depending on how bad it gets, how big the panic is, property might outpace, so you might even be able to make even more in terms of nominal value on that trade. But the thing that you really have to remember, and this is super important, is you can't think in terms of dollars, okay? Look at like a silver gold to oil ratio. Look at a silver gold to land ratio. This is where the big gains in the future can be made. But again, I think that physical is going to be the only way to go, because if the macerations in the market get too tumultuous, big words, right? If they get completely out of control and the dollar is rapidly losing value, by the time that you sell like a GLD or whatever, you get the money in your account, transfer it out, and then you go to buy land, you could be losing lots of money. And so this is in a scenario where hyperinflation starts to set in without a complete economic meltdown. And I think that even though you might get a complete economic meltdown, in the short term, you are going to see the hyperinflation kick in. You're going to see, but it's just money printing. It's plain and simple. I mean, we're doing exactly what it takes to get hyperinflation. It's just a question of when. But I'm looking for this trade, I don't know, 1 to 2 years out. 1 to 2 years out. And it could be short term. I mean, it could happen literally within a matter of weeks. So you might not have that 4 to 6 month window. You know, let's say something happens and there's a run on the dollar. Gold and silver spike out of control. You know, gold goes to $100,000 an ounce, let's say. Because remember, there's a lot of money out there chasing a very small pile of gold. I think that overall, all the gold in the world is something like it could fit on a tennis court, like 50 feet high. I mean, it's not very much, guys. So in that scenario, you have to be ready to move. But this is contrary to basically what I've been saying before, which is the fact that, you know, it will keep up with inflation. And that's the other thing. This is a very, very low risk trade. They're not going to tolerate deflation. If they don't tolerate deflation and you have gold and silver, it's going to at least keep up with inflation. And if you have this overshoot, the overshoot theory, huge gains. I'm talking 10 bagger. Possibly even more. I don't know. We'll see. So that's my theory, guys. Thanks.